Nice. We are live.
Oh, we're no intro right now. My bad. Welcome back. I thought you were going to run the video first. So
let's do it now then. Let's do it now.
All right, now we can say officially welcome back to Blockfield. Sorry about that quick opener. But we are joined with Jim Hiltner, who is the co-founder, head of business development over at Superstate. Prior to that, Jim spent some time over at Compound Labs, Pagaya Investments, as well as director of sales at Visible Alpha. I won't go through the entire list, Jim, but welcome to Blockfield. Very excited to have you on the show today.
Thanks for having me, guys. And I'm glad we got the video in there. It really hyped me up. Excited for the conversation.
Great to have you, Jim.
We need that intro for you. So Jim, as coming from the BD side, sales side, Sean, Avi, and I love having you on here as also a co-founder and BD. It's a fun title. Would love to hear from you, like Superstate. What is it? What do you do in your role as like head of BD? And like, how does BD finally get the respect they need? Because it's definitely been like a Twitter thread or Twitter like common theme we've seen, either jokes for or against. So very timely that you're on here.
Well, I appreciate it. Yeah, I mean, my background is all traditional finance. Going from the banks and into tech, and then further into what we're building at Compound and now into Superstate. So the progression of my career has just been trying to get further out the tech and innovation curve as capital markets continue to innovate and desperately need to do so. Superstate is at the forefront of doing that. Our experience being at a large DeFi protocol and being crypto native has allowed us to see the phenomenal technology that's available for traditional assets to integrate with these rails. And instead of sitting back and doing that at one protocol, we decided let's launch Superstate and do it the right way. And the right way is always the hard way. And, we've built our business to be completely regulation focused from the ground up. So everything we do underneath the hood doesn't really look that sexy in terms of the infrastructure, and that's intentional. But the way that investors interact with the products that we offer is actually really cool. Shareholder ownership that doesn't just sit siloed on a spreadsheet or in a brokerage account, that can actually interact on chain and opens up just a ton of surface area for different applications and liquidity opportunities and secondary markets that are really, really challenging in the traditional world. So, Superstate in a nutshell is trying to bridge the gap, very cliche, but, taking all of the assets that are sitting in trillions and trillions of dollars that don't have the superpowers of a blockchain and just upgrading the entire system and doing that, through a completely verticalized business where, we're not only doing the regulation, the compliance, the ops, but, building out the technology side so that the products that we offer, allow investors to do a whole lot more with them and underneath the hood get the exposure that they're looking for their portfolio for various purposes.
Yeah, no, I think that makes complete sense. I mean, watching this space evolve, it's been quite the journey. I mean, I think first evolution of this was, why tokenize anything? And now people are actually, it's kind of like anything else that's evolving. And on that note, Superstate focuses on modernizing the investing through tokenized financial products. How do you see the landscape of tokenized assets evolving, and where does Superstate sit in this? In play in that transformation that's occurring right now.
Yeah. So when you talk about assets, obviously it is a very broad category. If you look at traditional assets, you could be talking about things like cash, aka stablecoins. You could talk about treasury bills, like the proliferation of funds that have been built over the last number of years. You could talk about real estate. You could talk about a whole host of other things. So that is a really, really broad spectrum. And I think the industry is continuing to progress up the curve to bring the types of assets that investors want exposure to in these ecosystems. And, you know, our viewpoint is to start at the bottom left corner of the efficient frontier and work your way up. And, you know, instead of just going and saying, I want to tokenize a building and put that on chain, you know, we're really focused on the demand side of it. And, you know, there's a little bit of a chicken and egg thing to solve for there, which is you need to build the assets in order for the investors to get the exposure, but you also need to understand the investor demands and deliver the assets that they're looking for in their portfolios. And so, you know, we take a very pragmatic approach to that, making sure that there's an alignment between the two of those, because I think, you know, over the last number of years, we've seen tons of different initiatives that have gotten off the ground, but haven't really taken off. And that's largely been just like issuer focused and proof of concept focused. Where what we're trying to do is really take it from, you know, an investor standpoint and build, you know, things that can actually, you know, leverage all of the infrastructure that's been built in new and interesting ways, versus just saying, hey, I have a token representing something. It's like, what can I do with that token? And locking some of those capabilities versus just saying, yeah, this is now a bond on chain. This is a bond on chain that is much more efficient from an origination standpoint, from a distribution standpoint, from a liquidity standpoint, from a collateral management standpoint, and marrying that with the capital markets that already exist on chain. As you know, look back a year ago or even further, you know, markets took a real big hit. And when markets take a real big hit because of a lot of the centralized failures that we all know took place, risk aversion bleeds into the market, and that reduces the yield opportunity in various protocols. So you were looking at, and even today you see some protocols where if you're lending USDC to these markets, you're not getting more than treasury bills. So a lot of investors wanted to, during the bear market, you know, reallocate their positions to be able to use higher yielding capital as collateral to fund their businesses in, you know, DeFi and CeFi, and even just to park idle capital to earn more than just nothing or less than what they should be getting from the US government, which is the Fed funds rate. So that's why I think the T-bill space has really picked up a ton. But as you know, continue to see, you know, where the Fed is moving, and we're going to talk more about markets, and so we can dive into some of that in a little bit. But you know, the progression I think is taking place. The beauty of what's happening in this cycle is, regardless of any volatility in the markets, you've seen a ton of institutional momentum just progress through that volatility, even despite headwinds in 22 and some in 23. You know, I think BlackRock, Franklin Templeton, Wellington, T. Rowe Price, you know, these are all big asset managers that are doing things actively, and they're doing it actively not just by themselves, but they're partnering with large protocols, they're partnering with regulators, and that's a lot different than prior cycles. And that's why I think, you know, the legs that we're standing on now have a lot more momentum behind them than what you saw in the past. I'll give you an example. Our fund, the US Treasury bill fund that we run, we sub-advise that mandate out. There's a large asset manager, Federated Hermes, who's also the same caliber of all the large institutions I mentioned earlier, with decades of experience managing assets. They are publicly, you know, promoting their partnership with Superstate. They're just excited about what this means for the future of their business, and this partnership, I think, exemplifies that hybrid approach that, you know, a number of players are taking the right way in, you know, flourishing this ecosystem.
I mean, they're big in the RIA space. Federated
They're
Hermes.
massive in the RIA space. They're massive in the insurance, the endowment space, and you know, they've got $800 billion in assets under management, and half of that is in the govy liquidity, you know, space. So we're super proud that we were able to establish a partnership with them and to have them be the driving force behind capital allocation to the mandate that we described. But they, you know, we have a daily communication with the PM over there who is Sue Hill, and she is fantastic at deploying capital on behalf of our investors.
We'll have to bring you back on to walk through that, how that all came out.
Yeah. I was just going to say, because some of the companies you mentioned have been around, you know, 50, 100 years. And obviously over that time frame, you can go ahead and build that trust, right? And I was looking at your past history. So Compound Treasury, you were part of the team that the first DeFi company to receive a credit rating from the S&P. And so my question is, one, from a BD perspective, I think trust is paramount. Anytime you're selling something, especially any financial instrument, you definitely need to have that trust. And so how have you, co-founding this company, built that trust early and often in such a new industry, right? Where you're trying to tap into these institutional and investors that have been around for, again, 50, 100 years, and building that credibility, I guess, mostly with institutional investors.
Yeah, I mean, I think it comes to experience. Robert hired me at Compound to help run the institutional business because of the resume you outlined at the top of the call. Prior to this, prior to Compound, I was, helping run bank partnerships for a large fintech. And, one of the deals that we worked on there, which is public, is US Bank. And they are the definition of a stodgy, old school, conservative bank. Mm-hmm. And the product that we were offering was, hey, we're going to drive an AI model into your credit card and personal loan issuance platform and tell you to buy risk that you wouldn't otherwise. And we're going to securitize that in the capital markets and offload that for you. It was an amazing theoretical value proposition, but the enterprise process that you go from that initial, hey, this seems interesting, to actually executing that takes a ton of work. And prior to doing the Pagaya, working at Pagaya, I was at Visible Alpha, and there was a big regime shift in the markets coming out of the UK called MiFID II, where asset managers needed to basically redo how they were spending their budgets for sell side services, whether it's corporate access or research or whatever it might be. So I say all that because during that time, we were working with BlackRock and Capital Group and Fidelity and Franklin Templeton and advising them. So you need to, number one, do your homework. Number two, be an extension of their business, and, just continue to progress that relationship all the way through to executing a deal. Now that takes a lot of work. And I think, Jody, you said at the top of the call, BD kind of gets a bad rep. And I think that's fair for a subset of the high flying, super quick, not willing to roll up their sleeves and do the dirty work type of the industry. But I don't think I interact with a lot of that type of the world. I mean, that's, maybe much more of a degen type of BD approach. There's a lot of really capable and institutional BD folks out there that are willing to do that. So fast forward to Superstate, because we were able to get a credit rating from S&P, and because of the experience that we've all had as a team, doing all the right things, being transparent, being, innovative, being, highly rigorous in our process, and being a partner for all these institutions has helped us, establish ourselves in the ecosystem. And that DNA, flows through everything that we build on our products, to make sure that our investors, who are all institutions, are comfortable allocating capital to the products that we offer, and know that day one, what they can do is already really cool. But day 5, day 30, fast forward 2 years from now, what they're going to be able to do is way more interesting. But it's all rooted underneath the hood in, a true focus in transparency, compliance, regulation. Like I said, we're doing the hard way. Our funds right now are ring fenced to just institutional qualified purchasers is the technical definition. We would love to be able to provide exposure in treasury bills or into our crypto carry fund to non-institutional buyers. But given the regulatory framework in the US, you need to register your fund as a 40 Act vehicle. We actually submitted a prospectus, to the SEC about a year ago, and continue to work with regulators to help engage the decision makers and the policy makers to ensure that this industry can flourish, and that it's not too dissimilar to what, ETFs did to mutual funds. This is an evolution of how investors are looking to get exposure to different asset classes. And that is something that not everybody is willing to continue to grind and do. Our GC worked at the SEC. He was at Coinbase. Our team has the S&P credit rating experience, and my experience coming from, Visible Alpha and Pagaya, really just roots all that in our DNA. And that's something that we ensure that we continue to produce every single day.
Really quick,
Jennifer.
Good. Really quick, I was just going to ask one thing. So the with regards to only being open to GPs right now, and and above.
Yeah.
Effectively, I guess we at first we thought people thought, oh, an ETF for Bitcoin is never going to get approved. An ETF for Ethereum is never going to get approved. it's going to be years. And here we are today, both approved. So just really quick on that, like on that evolution, like, are you seeing that evolution pick up and adoption pick up? Are you seeing, you know, especially like that knowledge transfer that needs to happen with the government and the regulatory agencies? Just curious your thoughts really quick on that.
Yeah, and I'm not a policy expert, but I will say there's definitely a gap between the staff and the commissioners. If you're familiar with the SEC and how it's structured, we were actually very pleasantly surprised on the rounds of feedback from the SEC that the staff is actually highly educated and aware of how these potential products could operate. It was not a what is blockchain type of question. It was much more deep and intelligent and sophisticated, which was really refreshing to see. Now, that doesn't mean that their willingness to engage and learn on this is going to turn into policy changes at the top of the house tomorrow. But that momentum, I think, is something that we're definitely seeing. And that regular engagement is highly encouraging, not just at the SEC, but even, you know, considering tokenized assets as equivalents to regular money market funds or other types of assets from a collateral standpoint, like the CFTC and a large working group that we're a part of is engaging to ensure there's equivalency between these different types of products. And I know that a large part of the industry, both on the asset manager side and as well as the prime broker side, and you name it, like all the capital markets, want to be able to encourage the regulatory bodies to view these types of products as robust as a 40 Act mutual fund or ETF. And that's not something that the industry is shying away from. We want to encourage that further progress. It's just going to take time. And these things don't happen overnight. As long as it takes to work with an institution to get them on board, it takes even longer to get the government on board. And that's something that we're encouraged to see just continues today. And obviously BlackRock doing what they did and all the issuers, not just BlackRock, of getting the ETFs approved is a major milestone. But there's so much more work to be done on other types of products that can actually use the blockchain instead of taking blockchain assets and putting it into a traditional instrument. Those are two different things.
Yeah, Jim, so you mentioned two products that you guys have, which is USCC, the crypto carry fund, and then USTB, the tokenized treasury bill fund. So beyond just being a BD superhero, you're also a portfolio manager involved at Superstate. Would love to hear from your perspective, like how your role is like right now, like this past couple of weeks, the yen carry trade unwinding. What are some things you're thinking about from a portfolio manager like point of view? And then how does it affect those two specific funds?
Yeah, absolutely. So I'll start with the first one, is the crypto carry fund. It's a really, really interesting product. It's actively managed by myself and Robert Leshner. We're both the co-PMs on the fund. Both of us CFAs and experience, doing this trade before we even launched the fund. It's a very simple strategy. It sounds complex when you just get finance jargon thrown in there and you're like, what the heck is basis? But really what it is the ability to take capital, deploy it towards crypto carry, which is long spot, short futures against it, and do that when the yield or the spread between those two products are juicy enough that it makes sense to take risk. Our view is if they're only 1% above Fed funds rate, why take risk on investor capital when you could just park your cash in T-bills and wait for the market to open up again for you to be able to deploy into basis? And so we're actively managing the portfolio and looking at everything that you described to make sure that we're allocating capital efficiently for investors. And basis is quite volatile. So I'll give you an example. We launched the fund at the end of July and deployed initial capital into basis, right around when Trump was speaking at Bitcoin Nashville. Like a bunch of leveraged futures buyers were coming into the market. So the spread between spot and futures was widening open to 14, 15%. The fund was able to deploy capital to take advantage of those positions in term futures. We don't trade perps, which perps much more volatile in terms of the funding rates than if you're able to, lock in quote unquote yield for an August, a September, a December expiry, which if you look at the holdings on our fund, that's exactly what we're doing, is we're holding those various calendars. That was really exciting to put those positions on for investors. What was also equally as exciting was when you had the yen carry trade unwinding at the beginning of August, crypto was down 20% and futures came in a ton. So that like 15% yield that you bought, that you were able to put the position on, you were able to then close that pretty quickly once the yield collapsed to like 5 or 6%. And we moved back into T-bills, protected investor capital, took, gains in the fund, and then we're able to redeploy it as the market came back. We're sitting in here it is, August 29th. We're like 4 days away from Labor Day. With that yen carry trade unwind at the beginning of the summer, you actually saw open interest in futures decline by 20%, which like very rarely ever happens. And usually that's because there's a lot of liquidations and, clearly with people being long leverage and Bitcoin and ETH dropping by 20%, people got carried out on those. We don't take any leverage in our fund. We are, very conservative from that perspective. But with the progression throughout the month of August, as people are like on vacation and like the markets, like even liquidity in spot is, dramatically reduced compared to a couple of weeks ago. It's just a natural time for the market to be a little bit quiet. So what we see on the horizon ahead of us is a lot of narratives coming online, especially with the Fed policy meeting in September. Some of the macro data points that you're seeing come out over the last couple of weeks that are positive about where this economy is heading. And, just the overall catalyst of, more activity coming into these markets once you get over the summer doldrums, so that we are able to then take advantage of opportunities as they come up. Again, we're pretty conservative. We've got, a decent amount of cash kind of sitting there ready to deploy as soon as we see spreads widen open again. And we'll continue to monitor for those types of signals. So we look at a lot of stuff. If I, kind of break it down, it's the macro piece. Of course, we're looking at, specific, fundamental data. We're looking at, metrics of different on-chain activity and whatnot. And I think, the way that we position the fund is set up for success. And, we're 30-day yield at 13-14% right now, which is proven to be a really good spot to park your capital in, especially as perps have actually gone negative over the last few months. And we don't have that kind of exposure in our portfolio. That's the carry fund, which, there's a lot to be talked about there. The one thing is I get asked a lot about the Treasury bill fund, because as I alluded to, Powell's pretty adamant in Wyoming last week that they're going to start cutting rates. Is that 25 basis points? Is that 50 basis points? I think beginning of this year, everybody thought they were going to cut 7 times and they haven't done any yet. So, and the market continues to rip higher. So, that is encouraging, and there's still $6 trillion sitting in money market funds. What I anticipate, though, is that, rates will come down, but not materially. I think, they're going to be pragmatic and be data dependent as they're continuing to express. And when that happens, Fed funds rate is going to come down and the yield on a Treasury bill fund is going to come down. But still, if you have a 4 handle on the yield, that's way better than 0% sitting in a stable coin or cash. So it's not going to be a completely washed out. The federal government needs to continue to make the yield at the front end of the curve attractive for investors. And that is because of the fiscal situation that we have in this country. And so my view is that we'll continue to see a progressive, reduction in interest rates, which might, reduce some of the appetite for Treasury bill allocation marginally, but not materially. And I think the inverse correlation between interest rates and bull markets in crypto is actually really bullish for what we're doing on the carry fund because of, the dynamics I described too.
Wow. I mean, that's quite a bit of information and definitely good stuff. So, industry adoption. I mean, tokenized assets, a lot of people will say, oh, we're still early stages of adoption. What do you think this is a common question, I get asked, what do you think are the barriers to wider adoption? And then, how is Superstate addressing these, barriers and overcoming them?
Yeah, definitely don't need to repeat all the policy and regulatory side, but clearly that's, a barrier for broad adoption, both for institutions to get comfortable, but also just for retail to be able to access these types of products. And, how do you structure them? And, what is the right registration? And, can you do that in a flourishing environment here in the US where the capital markets are so large? And that's going to continue to, be unblocked, but it's not going to happen overnight. I would also say there's a large, it's challenging for big institutions to get involved in size. I talked to a lot of the larger, actively managed hedge funds that want to participate in this space, but they need the right counterparties. They're not going to trade necessarily directly with a small OTC market maker or prime broker in the crypto space, because the balance sheets that they want to deploy are multiples of the size of the actual counterparty's balance sheet. So they want to see Goldman, they want to see JP, they want to see like all these big primes that they already do business with, where they can cross margin other assets that they have in their portfolio to participate in these markets. And there's a lot of restrictions that the bigger banks have on trading and interacting with these markets, just given the regulatory environment. And then the big piece too is on the custody side. Clearly banks are really impacted from a RWA, not real world assets, but risk-weighted assets perspective when it comes to custodying digital assets, given some of the rules that are out there in the SEC now. And so that also inhibits the ability for large institutions to participate, where they can trust that, BNY Mellon or State Street are the ones that they're parking all of their capital with today, and they trust them because of those institutional, experience. As soon as they're able to participate, I think that also helps unlock some barriers. The third piece, I think, is really around the actual capital markets in terms of protocols when it comes to swapping or borrowing or lending different assets. I think there's a concerted effort that the industry is making now to really level up the infrastructure around things like a DEX or things like a borrow lend protocol that can interact with the securities world. And that's something that we engage with on a regular basis with the top protocols like the Uniswaps and the Morphos and the, you name it, that are all trying to find ways to allow the systems that they've built, which clearly, we sat at Compound, we watched everybody blow up in 2022, and, Compound protocol just kept humming along and still does today because the risk management is there and it's highly sophisticated and it's not centralized. So the ability to leverage those types of networks with the securities world, I think, is something that's going to unlock a ton of opportunity for investors to be able to participate. And before that, just having a token represent, your treasury bill allocation, if you're a big asset manager that already has a bunch of T-bills sitting in a bank, is not that attractive. But as soon as you can do things with it in a much more, automated, programmatic, efficient way, that's where I think you'll see a lot more TVL come into these markets.
You got to ask, with conference season coming up here, what I've noticed is there's been a lot more institutional folks coming to the traditional things like Consensus. I know Permissionless now. We're going to be actually one of the media partners at RWA Day, which is a day before Permissionless now. Where are you guys going to be going? I think you guys mentioned something in New York, and on top of the events, I guess, as well, any new products that are coming or you guys can tease out in the next 6-12 months?
Yeah, I mean, we're going to be everywhere. We're pretty discerning about the events that we attend. You could, as a BD person, spend all your time at conferences and never doing any work. And I'm very adamant that that's a colossal waste of time. And so we are going to be at Token 2049, which I think is, becoming one of the biggest events, if not the biggest event in the space, both from like a protocol standpoint, but also from an institutional standpoint. It's really brought a lot of that together, and the investor base that comes to that on the family office and the RIA and the institutional allocator side is really interesting. Solana Breakpoint is right around the corner from that, so we'll be attending that as well. And then you'll see us at the Masari Mainnet. Superstate hosts as the premier sponsor of RWA Summit in the end of October in New York City. And yeah, we actually shared a calendar. So if you go to our Twitter, you can see a whole host of events that we're going to. Actually, what's interesting is that I live in San Diego. So I'm right around the corner from, I think, one of the largest RIA conferences in the world. And Sean, we were talking about this space a little bit beforehand, so you might be going too, but there's an event called Future Proof. And I think if you look back at the last couple of years, there's probably like maybe 1 or 2 people that were speaking about things that had to do with crypto. Yeah. And, you got like Matt Hogan from Bitwise. It's like a premier title sponsor or speaker at this event, which is just great to see that exposure. And what's interesting actually, so they do a speed dating matchmaking type of a
service. I was there last year at it.
Yeah. So when you go through the application that they built, there's 3,000 people that are attending, and you can filter for people that are interested in crypto and digital assets. And I'm not going to lie, my heart skipped a beat waiting for it to refresh to see what the results were going to be. And the numbers were astronomical of folks that are on the allocator side, whether it's like family offices or RIAs or whatnot, that are interested in the space. And I think it'd be interesting to hear from them, how that number has changed over the last few years, because I bet you it was 0.1, it was 10 basis points. And then now it's, probably 10% at least. And, going forward, I'm sure that number will become a lot larger as people start to get more educated from an allocator standpoint on the space.
I mean, to give you some context of how the time.
I was just going to jump in real quick just to piggyback off that, though. Is a lot of that, do you think, from, the access now with the ETFs? Finally talk to their clients about this?
Yeah, 100%. And it's not just the access. It's the fantastic work that the folks at Bitwise and BlackRock and Fidelity and Franklin and all these issuers have been doing, promoting the utility of Bitcoin as part of an investor portfolio and an allocation. And you see that in the 13F filings that, it's not just your millenniums of the world that are trading it because they love vol. But it's large RIAs and family offices and big allocators, even on the state of Michigan or state of Wisconsin, announced that that they have a position. So part of it is
Morgan Stanley just opened it up for two.
Exactly.
Yeah.
So this stuff is all
baby
happening.
steps, but once you open that door, it's going to be pretty hard to, the momentum is going to continue to pick up and pick up and pick up. And I think actually tokenization as a topic is actually going to decrease, if that makes sense, in the sense that tokenization is really an afterthought. It's really, what are these funds producing? How, what are they on? What protocol? Things like that. That's really what's important. I mean, tokenizing a fund isn't exactly, I think it's been done.
I agree.
A lot of times. So,
and these things are going to be abstracted away where does anybody have any idea of how your stock actually trades? And does anybody understand the infrastructure of where data is hosted, in terms of cloud infrastructure? No, that is for a certain subset of really interested people that want to lift under the hood. But, you look at what Robinhood did, right? Robinhood bought a crypto exchange. And so they're clearly gearing up for the efficiency of their business to be optimized with these rails. And you're going to log into Robinhood and it's going to look exactly the same when you buy Bitcoin, ETH, or Tesla. And those just might all trade on Ethereum or Arbitrum or Solana or some other chain. But you're never going to know that. And that's all going to be abstracted away from you. So I agree with you. We talk about tokenization as being, this paradigm shift in the markets, but it's the utility of those tokens that really matters.
I actually think that's been a huge hurdle for the market because, obviously all the horror stories of blockchain of, there was one that came out yesterday that this has been the biggest year of, losses involving, different crypto. I mean, come on. Of course it's getting bigger and bigger. So there's always going to be bad actors and everything. And, that's the type of stuff though, that the traditional market hears and they just run out the door and they're like, nope, not touching it. It's all fraud.
Yeah. Cause they're risk managers. And I don't blame them. Right. I think it was it 22 or 21? It was, billions of dollars of hacks and high profile hacks that took place because of, either poor security practices or bad architecture or just pure market manipulation. So to go to your investment committee and say, hey, I want to deploy capital in this space, and we might lose all of it without, without the right kind of protections on it, is just never going to happen. And that's why we're building towards a world where the real like institutional capital and like real capital markets go is with trusted third parties that like have the infrastructure, that know what they're doing, like Anchorage, BitGo, Fireblocks, like they're all building these tools. But then you have like, what Boney and State Street and all the others are doing in order to facilitate these markets is going to be totally different than just like setting up a MetaMask and going to Compound and lending and hoping that you wake up tomorrow and it's still there. I mean, that type of stuff just
the
doesn't.
Old school days.
Yeah. And the old school, by the way, is like 4 years ago. And it feels like an eternity for all of us, but
I know. So
we always joke. Usually, you ask people 5-10 years down the line with crypto. It's 5 to 10 days. What's the difference going to be? You brought up an interesting point though with the abstraction. I think that's going to bring more and more folks in. We were just talking with Camp Network yesterday, and I come from like this UX background as well, and he was talking about like there's all these like Web3 social platforms, but everyone's still on Web2, right? And so and then like similar with like Robinhood. They have such a great UX, and you're not really thinking about what's happening on the back end, and that allows the masses to come in and not feel stupid when they're walking in, because a lot of people, if they don't know the answer to something, they may shy away or they may talk shit against someone. But in reality, I think this will help too.
It's funny because I don't know. I saw a tweet the other day, and it was like, it used to be called online poker, and now it's just called poker, or it used to be called online gaming, and now it's just gaming, or online community interaction. It's just called social media. Like these things seem, very different to a user until it just becomes part of the norm. And, I think there's a major opportunity. Like, I'm a big Coinbase wallet maxi. I'm the first time I'm ever saying this out loud. So shout out to the Coinbase wallet folks. Like, what they're doing with Base and what they're doing to integrate that with the exchange, and how the different applications and chains that allows you to interact with. Like, it feels much more natural than like, holy crap, I'm like signing these transactions, I got to go to all these disparate systems. Like, these types of products are being developed, and that's going to be a big unlock. And that, from an institutional standpoint, from our, like, give another Superstate plug, like, we've built a very seamless interaction for clients to go in and out of our funds. They don't even really like know that we're doing things on chain to a large extent. They've got an investor portal. They can see their statements and their transactions and their balances and all the holdings and the fund documents. It's like you would when you log into any brokerage account. And, we facilitate that in and out of their wallets really seamlessly and keep them updated along the way. So the UX is really important to us. And one of the things that I really hear a lot from clients is onboarding sucks. It's just like so miserable. You have all these teams that are wasting all their time doing all this paperwork and back and forth and yada, yada. We just said, screw this. We're going to build our own onboarding portal, and clients do it in less than 30 minutes. It's one page, they fill it out, and then they can start interacting with the product shortly thereafter. We still have to do all of our compliance checks and all that review. And like, we're really set up well to process that kind of stuff quickly. But our focus is not just building like really cool funds that have a token, but the experiences around that from an end-to-end lifecycle standpoint.
I mean, that's, I think, one of the biggest hurdles from my experience in the private market. Like, it is, each time you want to get into a private fund, it's literally like, oh, I got to go through my life story again. And so, first, I mean, this is 2024. Like, if you can't open up an account electronically, I mean, people are just going to close out and say, forget it.
Yeah. And then they miss opportunities, which is the unfortunate
Then
part.
they get mad.
Yeah, exactly.
Yeah.
Jim, before we let you go, back on the macro side, you have the yen carry trade, something that like shook the VIX. People were like panicking. They're like, oh, wow, like, what is being made, or like what's inside the sausage? What do you see as, potentially another, systemic like currency risk like that's, part baked into our financial system? Is it like the Chinese yuan carry trade? Is it, what should people, be researching into and looking ahead to see as potential risk for all markets, not just, digital assets?
Well, I'm an armchair economist, I guess. So, take all this with a grain of salt. I read The Economist every week, so I keep a pulse on the macro, but I'm certainly not the expert. But I would say, yeah, I mean, you saw a lot of systematic deleveraging through minute data points in, jobless claims, and, like GDP just got lifted again, and that's why the market's rallying today. But you have the Fed's being data dependent, but then you also have like a lot of the positioning in the system that's like not really fundamentally driven. It is very systematically driven. So, the spike in the VIX going to 60, it was like as if the world had closed down for another pandemic. And that was just kind of crazy, right? People were, especially because you don't have 24/7 markets, and something is happening in Japan on a Sunday night in the US. You're like, holy crap, what's going to happen Monday morning? Let me buy puts. And like, that's why the VIX spikes, and then it unwinds like shortly thereafter. And, a lot of people lost a lot of money. A lot of people made a lot of money, but that's just like, now you look back, and aside from you asking me this question, I think a lot of people are going to forget that even happened 24 days ago. So yeah, I mean, like there's some interesting things happening, like in China, they had their third plenum early this year and really come out with a bunch of different policies on like what they're going to be doing with their economy. But I know that they're, intervening a little bit on the currency and the treasury side on the issuance piece. So, potentially maybe there's some opportunities there to watch out for. But I would say, the biggest risk that we pay attention to is liquidity. And, if you look at where the cycle is heading, the rates are going lower. The monetary fiscal policy is going to continue to be really bullish or dovish. And we'll just continue to flush the system with cash. I think that to us is a really good tailwind for all the markets that we pay attention to. But it also is a little bit concerning when you look at like the top 7 stocks continue to just take up more and more of a percentage of the total returns of everybody's portfolio. And so, because of this passive boom, which I think is a fantastic innovation, I think people, will wake up one day and look at their 401k and say, hey, this is great. And then wake up another day if things, unwind, and people will be, pretty shocked by that, especially given the demographic situation we have in this country. Folks are going to be relying on that type of a cushion. So, yeah, I mean, we keep an eye on things that we really focus on in more of the crypto related markets. I think, open interest is really depressed in futures right now. And we anticipate that to come back as, folks get back in the saddle heading into September. So we're excited and positioning the book accordingly.
You gotta ask about the Basquiat behind you. You got the king, the T-Rex.
Yeah, it's wife and I went on art.com because we're not really that creative, and both landed on this being our favorite piece. So here it is behind me. And actually it's supposed to be set up so that if I have good posture, the crown is at the top of my head. But I'm always slouched over. The best part about it though is we got the Superstate logo in the top right corner. So I got a nice Easter egg there and a compound logo on the left too.
Love it.
Nah, that's cool. Well, thanks so much for coming on, Jim. This was awesome, and definitely would invite you back anytime you want to come on, because I think it's an ongoing news cycle and everything changes, right? So would be a pleasure to have you back anytime.
Appreciate the opportunity, guys. It was great to chat.
Yeah, really appreciate it, Jim.
Thanks, Jim.
See you guys.
Bye.